at today is referred to as the rat trap. The rat trap takes advantage of failed breakout trades. So the first point I'd like to get across to you is that you should never take breakouts, because the vast majority of them fail, and it's probably the least more successful trading strategy you could attempt to employ. What we want to do is use a failure of that price structure to our advantage by using the losing psychology of those breakout traders as an opportunity for us. The first thing that has to be present when taking a good rat trap is there has to be some good context to the price action pre-trap. And what I mean by that is that the market needs to have been moving in an obvious fashion just before the trap sets. The reason for this is that it draws traders in to taking some risk. It's eye-catching. It's the type of price action that induces and seduces the breakout trader into the game. So this is a critical element to trading the rat trap successfully. As you can see in this area here, price has been dropping sharply, making a series of lower lows and lower highs. Price puts in a new low down at the bottom here and then rallies away from that point. As price comes back into those lows, it breaches those lows, inducing the breakout trader to take a short. And no sooner did it breach that low, price rallied aggressively away from that level. Up until that moment, price had been in a downtrend, making a series of lower lows and lower highs. But then it puts in a higher high, as depicted by price breaching that prior swing high. At this moment, price had then gone into a range, as it had failed to continue with that trending structure. What I need you to think about is the losing psychology of the trader who sold that low. And I want you to consider that they held on to their position until price was up here. What's their mentality like? Imagine they'd taken too much risk. Then consider how they will be feeling as price starts to turn back in their favour. Think of their psychology now. It's improved dramatically, and they think that they're going to get out of this trade alive. Their expectations have shifted from this trade entry down here, which would have been all about making money, to a new type of mindset, which is all about not losing money. As price goes up again against their position, they may be thinking at this point they should have exited down here. But then price does indeed follow through and gives them the perfect opportunity to exit at break even. Now, if a trader sold down here, originally trading that breakout to the downside, the transaction that must occur for them to get out of this trade is a buy transaction. So that creates in this area here demand. I also want you to consider the other market participants that may be involved in this trade too, which can add weight to our overall trading profitability. As you can see, we do have a level of resistance up here, and if you have a trader that is selling off a double top in this area here and they're making money on the way down, where may they take some profit? Prices are ranging, it's likely that they'll try and take some just ahead of that level. And if they're sold up here, the transaction that must occur for them to get out of that trade with money in the bank is a buy transaction. Thus adding weight to the fact that there should be some demand in this area over and above the fact that these traders were just exiting their losing positions. Also, this looks like a double bottom, so you're also going to have some level traders entering in long positions here and trading back to the other side of that range. This all adds to the demand equation, which increases the chances of this being a profitable outcome. Never ever take breakout trades. Always allow traders to take those trades and get caught up at the hard right edge of the chart. Sit back, wait, be passive and measured in your approach, and reverse engineer these levels so that you can see where traders are trapped at these breakout locations, and for best results, look for these trades at recent highs and lows in price, because prior to that happening, price would have been on the move, and that's precisely the type of price action that will induce the trader into the game. Once they're in, once you can see that there's been some confirming price action which confirms the breakout, watch for price to aggressively move away from that position, and then you know people were down in there and trapped, because humans hate to lose, and oftentimes they'll cancel stop losses, take too much risk because they don't want to crystallize the loss. As price comes back into this area, always look for some confirming price action. Never just place orders at these levels. News events, etc. have a funny habit of messing with the supply demand equation, and if you're not around watching price action in these levels, you may get stopped out. Place your stop loss on the other side of structure and trade it back across the range, always making sure you're making twice what you risk.